Mazzei says oil companies left Oklahoma because of taxes. The companies tell a different story. Houston attracted energy headquarters because of industry connections, corporate consolidation, and access to markets, not because Oklahoma failed to eliminate its income tax. Meanwhile, meaningful property tax relief already has a bipartisan, affordable starting point. Mazzei wants Oklahoma voters to believe the state is losing major energy companies because Texas does not have an individual income tax. His campaign specifically points to Devon Energy and Expand Energy, the company formerly known as Chesapeake Energy, as evidence that Oklahoma must dramatically cut its income tax and eventually eliminate it. The argument sounds persuasive until someone asks an obvious question. What did the companies themselves say? Their public statements tell a substantially different story. Devon described a major corporate merger, operational efficiencies, and the advantages of locating executive leadership in Houston. Expand Energy identified relationships with industry partners and access to global natural gas markets. Neither company identified Oklahoma's income tax as the reason for relocating its headquarters. And another example makes the weakness in Mazzei's argument particularly clear. ExxonMobil also moved its headquarters to Houston. It moved from Irving, Texas. Unless Texas somehow had a different state income tax in Irving than it did in Houston, something other than state income tax rates was driving that decision. In February of 2026, Expand Energy announced plans to relocate its corporate headquarters from Oklahoma City to Houston. The company did not say Oklahoma's income tax drove it away. It said the move would focus primarily on executive leadership and strengthen relationships with industry and commercial partners. Oklahoma City would remain an important center for its business and operations. Interim Chief Executive Michael Wichterich pointed to Houston's position as a gateway to the global natural gas market. That is a commercial explanation, not a tax explanation. Expand Energy competes in domestic and international markets. Houston provides immediate access to trading relationships, commercial partners, infrastructure companies, service providers, financial professionals, and the broader energy industry. The executive team can meet potential partners across town instead of arranging flights every time a major opportunity emerges. That does not mean losing a headquarters is insignificant. Executive positions, civic leadership, and corporate decision-making matter. But presenting the relocation as proof that Oklahoma's individual income tax caused the move requires evidence the company itself did not provide. Devon's relocation followed its merger with Houston-based Coterra Energy, creating a combined company with an enterprise value of approximately $58 billion. The companies projected approximately $1 billion in annual pre-tax efficiencies from the merger, citing complementary assets, operating improvements, technology, and streamlined corporate costs. The official merger announcement said the combined company would be headquartered in Houston while maintaining a significant presence in Oklahoma City. During an investor call, Devon Chief Executive Clay Gasper explained that the headquarters designation meant the executive team would relocate to Houston while Devon maintained a substantial Oklahoma City presence. The distinction matters. Moving executive leadership is not the same as moving every employee, abandoning technical operations, or shutting down Oklahoma's participation in the energy business. Gasper described the Houston decision in terms of opportunities available to a combined company of that size. Devon's public materials emphasized merger economics, industry scale, and corporate strategy, not Oklahoma's individual income tax. In 2022, ExxonMobil announced it would move its corporate headquarters from Irving, near Dallas, to its campus north of Houston. Irving and Houston are both in Texas. Both operate under exactly the same state income tax system. ExxonMobil explained that the move would improve collaboration, integration, operational efficiency, and the coordination of technology, engineering, and support services. Its announcement described a broader restructuring aimed at reducing costs and improving performance. State income tax differences could not explain a headquarters move between two cities in the same state. Houston won because it offered advantages associated with the concentration of energy industry operations and expertise. If Mazzei's theory were sufficient to explain where energy companies locate, ExxonMobil could have remained in Irving. The tax rate would have been exactly the same. The movement of energy headquarters toward Houston did not begin with the current campaign. Reading and Bates, once a major Tulsa-based drilling company, moved its headquarters to Houston in 1989 as the company restructured and concentrated increasingly on offshore drilling. Parker Drilling, another company founded in Tulsa, moved its headquarters to Houston in 2001. A Parker Drilling spokesman explained that Houston was where many of the company's customers were located. Founder Robert Parker offered an even more revealing explanation in an oral history interview. He recalled being told that the company needed to relocate because its customers and the people making industry decisions were no longer concentrated in Tulsa. The issue was access to business relationships. At the time of Parker's relocation, approximately 50 employees moved from Tulsa, while the company anticipated having about 140 employees in Houston. That history reinforces the same distinction visible in the Devon and Expand announcements. Corporate headquarters and executive decision-makers may follow industry networks even when substantial work, employees, or operations remain elsewhere. Houston concentrates oil and gas producers, drilling contractors, equipment suppliers, pipeline companies, financing, legal expertise, trading operations, and international energy markets. Halliburton's senior corporate officers, for example, are based in Houston. Businesses often cluster near the people they need to meet, negotiate with, and hire. A lower tax rate cannot magically reproduce an entire industry ecosystem. None of this means taxes never matter. Businesses evaluate taxes, labor costs, infrastructure, workforce quality, market access, regulatory requirements, and many other factors. But claiming a particular company moved because of taxes requires more than pointing out that the destination state has a lower tax rate. The relevant question is whether that company actually identified taxes as the reason. The public record identifies mergers, commercial relationships, corporate consolidation, access to markets, and Houston's concentration of energy industry decision-makers. Mazzei nevertheless asks voters to accept the headquarters moves as justification for cutting Oklahoma's top individual income tax rate from 4.5% to 3%, then eliminating the income tax within 6 years. Mazzei's campaign website also proposes eliminating deductions and exemptions, cutting corporate subsidies, removing many existing sales tax exemptions, and shifting toward taxes tied more heavily to consumer spending. That is not simply a tax cut. It is a proposed restructuring of who pays, when they pay, and what public services can be financed. Mazzei argues that significant income tax reductions can be financed by eliminating tax preferences. Some of those preferences deserve serious scrutiny. Oklahoma operates an extensive shadow budget of tax credits, exemptions, subsidies, and other preferential treatment. Programs that cannot demonstrate a reasonable public return should not continue indefinitely simply because they have influential supporters. But removing a tax preference is not the same as discovering free money. If a deduction, exemption, or credit disappears, someone who previously received it generally pays more. Mazzei's own campaign identifies more than 200 sales tax exemptions as potential targets and proposes a model more dependent on consumer spending. Oklahoma families deserve to know which exemptions would disappear, which corporate subsidies would remain protected, and whether farmers, manufacturers, small businesses, or ordinary consumers would pay more. How much additional sales tax revenue would be needed? Would lower-income and middle-income families pay a larger share of their income through taxes on purchases? And how would Oklahoma replace the revenue from fully eliminating the income tax after the first round of credits and exemptions has already been used to finance the initial reduction? Until Mazzei publishes an itemized accounting, voters cannot determine whether the promises represent genuine savings or a transfer of costs. A government can collect the same amount of money while shifting the burden from one group of taxpayers to another. Calling that arrangement revenue neutral does not make it neutral for the people paying the bills. Mazzei also promises to eliminate homestead property taxes for seniors and veterans. The concern behind that proposal is legitimate. Rising valuations and higher property tax bills can create real hardship for retirees, disabled homeowners, veterans, and families whose incomes have not kept pace with costs. People who worked for decades to remain in their homes should not face financial instability because public policy failed to keep up with inflation. Eliminating property taxes for broad categories of homeowners regardless of income creates a different problem. A high-income retiree capable of comfortably paying property taxes would qualify for relief simply because of age. Meanwhile, a struggling homeowner who is younger than the eligibility cutoff might receive nothing. Veterans also have widely varying financial circumstances. A policy based exclusively on veteran status, without considering income or financial need, would distribute public benefits to people who may not require assistance while leaving others exposed. The goal should be to protect people at risk of being priced out of their homes. That requires an income-sensitive approach, not a blanket exemption. Oklahoma does not need to invent a completely new system. It already offers a refundable property tax credit for homeowners who are at least 65 years old or totally disabled and meet the income requirements. The problem is that those requirements have become detached from economic reality. The existing income limit is just $12,000 per household. The maximum credit is only $200. A senior receiving $1,100 per month would have annual income of $13,200 and generally earn too much to qualify. That is not meaningful protection. It is an outdated rule that inflation has steadily transformed into a barrier. Official state figures show that only 1,787 taxpayers claimed the property tax credit in tax year 2022, receiving approximately $333,000 altogether. The average benefit was about $186. Oklahoma did not eliminate the program. It allowed inflation to eliminate most of the people the program was supposed to help. Republican Senator Dave Rader introduced Senate Bill 45 to modernize the existing property tax credit. The proposal would increase the household income eligibility limit from $12,000 to $38,000. It would also increase the maximum available credit from $200 to $2,000. Senator Rader's proposal would more than triple the household income eligibility ceiling, increasing it from $12,000 to $38,000. It would increase the maximum available property tax credit tenfold, from $200 to $2,000. Those changes would direct meaningful assistance to older and disabled homeowners with modest household incomes. The Oklahoma Tax Commission estimated that approximately 3,254 additional taxpayers could qualify and that the maximum estimated reduction in state income tax collections would be approximately $6.5 million annually. The agency explained that the actual cost could be lower because many qualifying households would have property tax bills below the maximum credit and might already receive other protections. Rader's proposal provides relief through a refundable state income tax credit. That means the assistance does not require removing the homeowner's property tax payment from the local funding system that supports schools, counties, and other services. That is fundamentally different from eliminating an entire category of local property taxes without first identifying how schools and local services would replace the revenue. Democratic Senate Leader Julia Kurt has similarly supported improving existing protections, including the senior valuation freeze and targeted property tax relief. That is the foundation of a bipartisan solution. And there is an additional wrinkle. Mazzei's own campaign website lists Dave Rader among his endorsers. A practical, targeted alternative has already been proposed by a Republican legislator whose support Mazzei advertises. The problem is not that Oklahoma has no possible solution. The problem is that Senator Rader's bill was referred to committees and never received a recorded vote. Lawmakers do not need another dramatic campaign announcement. They can revive the existing proposal, refine it, and direct relief where the financial need is greatest. Any serious reform should do more than raise the income limit once. The eligibility threshold and maximum benefit should automatically adjust for inflation. Otherwise, Oklahoma will repeat the same mistake that turned a $12,000 income ceiling into an almost meaningless qualification standard. Mazzei's own campaign acknowledges the broader problem. His website points out that Oklahoma's basic homestead exemption remains capped at $1,000 and says the amount has not changed since 1987. If the candidate recognizes that decades without adjustment have weakened an existing protection, The logical response is to modernize it and prevent the same erosion from happening again. Oklahoma's promise illustrates why indexing matters. 4 years, the scholarship program used a fixed $50,000 family income eligibility limit. The Oklahoma State Regents documented that $50,000 in the year 2000 would have required approximately $69,330 in November of 2016 to provide equivalent purchasing power. As incomes rose in dollar terms, families increasingly crossed the fixed Oklahoma's promise eligibility line even when their actual financial circumstances had not improved enough to make college affordable. The state regents reported that high school enrollment in Oklahoma's promise declined from 9,640 students in 2014 to 7,981 in 2019. After lawmakers increased income eligibility, participation improved. The first class covered by a $55,000 limit increased to 8,359 students. Subsequent changes helped raise enrollment to 9,258 for the 2023 class and approximately 9,300 for the 2025 class. That is measurable evidence that modernizing eligibility standards can restore access. The lesson applies directly to property tax relief. A fixed dollar threshold is not a permanent protection. Without inflation adjustments, it is a benefit that becomes less effective every year. Raising an eligibility limit without indexing it would merely restart the same countdown that weakened the existing program. Property taxes help finance public schools, career tech, county government, libraries, and other local services. Removing a significant category of property from the tax base does not eliminate the cost of providing those services. The money must eventually come from some combination of reduced services, replacement state revenue, greater contributions from other taxpayers, or newly approved local taxes. Mazzei's own campaign acknowledges that local voters might have to decide whether to replace lost collections. That is an important admission. A tax reduction financed through another local revenue source is not necessarily an overall reduction in the community's financial burden. It can simply transfer that burden to somebody else. A refundable, income-sensitive credit offers a more careful alternative. It can protect vulnerable homeowners without automatically removing the property tax revenue that supports local budgets. Additional reforms to assessment practices, senior valuation freezes, and eligibility rules may also be necessary. But Oklahoma has realistic options between doing nothing and dismantling a major source of local funding. Mazzei is correct that many Oklahoma households are struggling with affordability. He is correct that outdated tax provisions and corporate subsidies deserve scrutiny. And he is correct that property tax protections have failed to keep pace with rising costs. But those legitimate concerns do not prove that Devon and Expand relocated their headquarters because Oklahoma has an income tax. The company's own explanations point elsewhere. The evidence does not prove that eliminating income taxes will stop energy headquarters from gravitating toward Houston. ExxonMobil's move within Texas makes that especially difficult to argue. Nor does it prove that abolishing property taxes for all seniors and veterans is the only way to protect homeowners. Oklahoma already has a framework for targeted relief, bipartisan interest, and an official estimate showing meaningful assistance can be delivered for a relatively modest and measurable cost. The choice is not between helping homeowners and abandoning them. It is between carefully targeted relief and expensive promises that leave someone else holding the bill. Before Oklahoma voters accept Mazzei's explanation for corporate relocations or his assurances about sweeping tax cuts, they should ask for the evidence, the itemized numbers, and the plan for protecting local services. Houston did not become the center of the American energy industry because Oklahoma forgot to eliminate its income tax. And Oklahoma does not need to destabilize local budgets to help seniors and veterans remain in their homes. Follow the money at williamlangdon.substack.com.